Hey guys, this is Andrew from Dividend Growth Masters, and today I want to talk about an option strategy to generate passive income. And this is one that I've been using for quite a while, and it involves selling credit spreads. Specifically, the strategy is called the bull put spread. So let's talk about credit spreads first. So basically, a credit spread, when it relates to options, is selling and buying options at the same expiration date. So you're gonna buy one option and sell another one on the same expiration date. They're gonna expire on the same day, but they're going to have different strike prices. And when you do this, you generate what's called a premium. So you get money upfront for opening this trade. And hopefully, if the trade goes right, you'll generate passive income because you'll be able to keep a large portion of the premium that you earned. So let's go through an example of this. Let's look at the option chain for the S&P 500. So let's just go easy and look at the December 20th one. And this is going to be 5 days from now. So basically, with a bull put strategy, you're going to sell and buy the put options on the same expiration date but different strike prices. So basically, what you're going to do is you're going to sell one put option. So let's say we're going to sell the uh, 389 strike put. That means we're going to generate a premium of about 420 or $4.27 or $427. So basically, we're selling the option, so we're generating a premium on that. Now, if you just sold a naked put option, then you are basically um, basically if the stock goes down, then you can have very unlimited risk. Well, not unlimited, but if the stock goes to zero, then basically you're out of your entire investment. But if you just sold the option, that's a that can be pretty risky because if the stock declines significantly, then you could lose a lot of money. So what the bull put strategy does is and you buy a put option. So you sell one put option at a higher strike price, and then you buy a put option at a lower strike price. So we're gonna sell the 389 strike put, and then we're gonna buy the 388 the 388 strike put on the S&P, and that's gonna cost us $3.76. So basically, we're gonna profit the difference. So 427 minus 376. So that'll be about 50 cents, 51 cents. And that's the premium that we earn. Remember, we're going to sell the 389 strike put. That'll generate $4.27 in premiums, but we're also going to buy the 388 strike put for 376. And the difference for that is 51 cents or $51 because it's for 100 shares. That's basically the bull put credit spread strategy in a nutshell. And the reason why we want to buy a put option is to limit the downside risk. So the most that we could lose on this one trade is the $1 difference between the between the strike prices. I mean, so it doesn't matter if the stock falls, if the S&P 500 falls to $350 because we have the 388 put to basically protect us from that downside risk. So basically, the the profit loss profile of a bull credit spread looks like this. So this is a strategy that works best if you think the stock market is going to be flat or if the stock market is increasing. That's why it's called the bull put strategy. So if the market is relatively flat or it increases, then the likelihood of the put option that you sold being exercised is very low. So that's why you'll keep the premium on the upside. But on the downside, if the stock if the stock drops, then you could be on the hook for the put option that you sold. But luckily, we also bought, I mean, a put option, which will limit the downside risk. That's why it's called a defined risk strategy, because you know exactly how much money you can make. The maximum amount of money that you can make is the premium that you earn from selling the options, the credit spreads, and the maximum loss that you could have on the investment is basically the difference between the option strike prices. So, an example, we sold the 389 put, but then we also bought the 388 strike put. So the difference between them, which is a dollar, basically $100, is the maximum loss on the investment. So the loss depends on the width of your strikes. So let's say we sold the 390 put, but then we also bought the 389 put. So the $3 difference, the $300 difference here between the width of the strikes, that's going to be the maximum loss. Now, most people, when they use the strategy, they typically do it for large cap stocks like Apple, Amazon, Microsoft, Google, Walmart, the big boys. But personally, I like to actually do the bull credit spreads for the S&P 500. And the reason for that is because it's easier to predict in terms of volatility. Yeah, the market can be volatile on some days, but if you're doing it for a tech stock like Amazon or even, Google, those stocks are really, really volatile. So it's very hard to get a good grasp of how high and how low the stock can go because they can move very, very violently versus the market, which is a little bit more stable. Now, this strategy is great when there's a little bit of volatility in the market because volatility is one of the largest contributors to option prices. Now, when you're looking at bull credit spreads, there are really two things that are really important. So let's use the S&P 500 for an example. So if you're going to do a bull credit spread, the first thing that you want to do is to pick your width of the strikes. So what's the maximum amount you're willing to lose basically? So, if you're willing to lose, let's say $100, then the width of your options should only be $1. And that's the great thing about the strategy. You know exactly what your maximum loss is going to be. And alternatively, you also know what your maximum gain is going to be. The next thing you need to consider is what strike to set what strike to set the option at for the credit spread. Now, in this case, it's going to be what strike are you going to sell it at because that will be the anchor to determine what price you buy the option at to set the option width. Now, typically for like an S&P 500 company, like the index, I would typically set the spread, set the put option strike price at around 7 to 9% lower than what is it trading at now. And the reason why I do that is to create a little buffer, just in case the market tanks, then you have a little buffer zone before the option becomes exercisable to whoever bought it, whoever you sold it to. Now remember, a bear market is when a stock market declines by 20% or more. By selling the put option at 7 to 8% lower than what it's trading at now, you set a little buffer just in case the market tanks. Now, the next thing you want to do is to set the expiration date. And typically, I like to set at least 90 to 150 days out. And the reason why I want to do that is because one, the the market, especially in today's world, is super volatile. So I want to give it enough time where the option, or if the stock market declines, then I still have enough time, you know, 3 to 4 months time for for this market to recover, so the options will not be exercised. That way, you can keep the premium on the credit spread. The cool thing about credit spreads is that you can also buy them back early. So, if you've already locked in a gain in the early days of the option, you can close it out and lock in the profit. Anyways, that's just a quick overview of the bull credit spread. It's a little, I guess it's more like an intermediate strategy, but it's still a great strategy that I use to generate passive income. So if you have any questions about the strategy at all or about the video, let me know in the comments below.